Hello everyone, I'm Shannon Raw with Tax Analysts. Thank you for joining us today for our latest in our weekly discussions on tax reform. Now, most of our past broadcasts have been focusing on the House GOP blueprint. Understandably, that would be a major change in the U.S. tax policy. And so it's understandable that many groups, including us, have been studying the economic consequences of that. But today we're going to concentrate on a slightly different topic, namely the value-added tax, or the VAT. The U.S. doesn't have a VAT, which actually makes us an outlier, globally speaking. Around 160 other countries have a VAT, including all the G20 nations, the OECD member states, basically all of our trading partners. So in that context, the lack of a VAT in our tax policy really stands out. But the VAT really isn't all that different from the very controversial border adjustment that features so prominently in the blueprint. There's definitely some similarities there. If the border adjustment proves to be a political liability, it's very possible that some members of Congress will propose we swap it out for a VAT and proceed with the rest of the blueprint unchanged. So to discuss that possibility, we are joined today by the Marty Sullivan, Chief Economist for Tax Analysts, and the Bob Goulder, Chief Tax Policy Counsel. So, to start us off, we sometimes hear about the cash flow tax, which is in the House blueprint, described as the economic equivalent of a subtraction method VAT, combined with a wage and allowance. But the express language in the House blueprint disavows that linkage completely. It specifically states that it is not a VAT. So, can the two of you reconcile those two observations for me?
Well, I'll try. That's a lot to ask.
Yeah.
But a cash flow tax and a value-added tax are not the same things, but they have a lot of the same properties. So I believe that technically the blueprint is correct that it is not a value-added tax.
Okay.
However, it is the kissing cousin of a value-added tax. Has a lot of similar properties. In fact, if you want to understand if you want to understand the House proposal, it really, the more you know about value-added taxation, the more it's going to be easier to understand.
Sure.
So a subtraction method VAT, you start with to figure out your taxable tax base. You start with revenue and you subtract everything. Subtract all your purchases. With a cash flow tax, as you have in the House bill, you start with your revenues, you subtract your purchases, but you also subtract wages.
Oh, okay.
So that's why, and wages are enormous component of cost,
Absolutely.
depending on the business. So as you said, if you play with the arithmetic a little bit, it doesn't take long to figure out that the House bill is exactly like a value-added tax. It works exactly as if you enacted a value-added tax and had a credit for wages.
Yeah.
So that's the difference between the two. So they're very similar, but they're not the same.
Yeah. What I thought was interesting, if you look at the blueprint, is that there are these pages where the drafters of that document are praising the virtues of a consumption tax base. You know, they start with a goal, an objective, and then they try to have the details fall in line from the goal.
Sure.
And the goal is economic growth, and they think you're more likely to have economic growth or positive growth effects if you sort of move, even if it's just gradually, from taxing capital income, say, to taxing consumption tax base. And that is one of the redeeming virtues of the VAT. I mean, it's regressive and there are these other things. But they praise that, you know, and they say wonderful things about it, but then they stop short of actually calling it a
Well,
VAT.
let me put it this way, you know, we have an ideal income tax and an ideal consumption tax. And we economists love the ideal consumption tax because that promotes investment and savings, which increases the capital stock, which increases productivity. And
all good things.
All good things. Even our current system, which is on its face an income tax, has elements of a consumption tax.
For sure.
For example, we have accelerated depreciation, and we have all the savings incentives. This House proposal is much closer to the ideal consumption
Yes.
tax. It has
Mhm.
expensing, which encourages investment and
Yes.
capital formation. That's on the business side.
Mhm.
And on the individual side, it lowers significantly the rate on not capital gains and dividends, but also interest. Interest now is taxed at the top rate of 39.6. It would be 16.5 under the House proposal. And also there's a whole bunch of extra special pension accounts.
Right.
So it's moved so that they can sing the praises of consumption taxes,
Right.
without being, they're not wrong, because they are moving in that direction.
Right.
Interesting.
But they're not all the way there.
Okay, and what you were describing was a subtraction method, VAT. And just to clarify, as you said, there's about 160 VATs out there in the world.
It's quite a few.
There's only maybe one, the Japanese VAT, that you'd describe as a subtraction method VAT.
Okay.
All the other VATs, the one you have in Europe, the one you have elsewhere throughout the world, they're something different. They're called credit invoice VATs.
Yeah.
And the details are different, but you end up in the same place where you have the consumption tax base.
Okay.
Well, do you want to talk about the difference between credit invoice and subtraction?
We should just a
method
little
VAT?
bit,
Let's do it.
because
Break it
almost
down a little bit.
almost every single VAT in the world is a credit invoice.
Right. Now, the political advantages of a subtraction method VAT as opposed to a credit invoice VAT is that it looks more like a corporation tax to your general public. So you look at GE or GM or whatever your favorite large corporation
Sure.
is, and you'd say, wow, they're paying this much
But are they?
business tax. So it has the appearance
Yeah.
of that, and that's very appealing to me. But for we tax nerds, the difference is under a credit invoice VAT. Let's say you're a retailer and you sell $100 worth of product. You're going to be taxed on 100.
Right.
In order for you to get refunds, you have to show the invoices. That's why it's called credit invoice VAT. You have to show invoices that prove that the people from whom you purchased it paid their tax. So there's that extra level of compliance.
Okay.
Because I'm going to be
built in.
audited, and when
Right.
you have a VAT audit, and
Right.
over in Europe, businesses are very used to these audits. They've got income tax audits and VAT audits,
Right.
and you have to show them the invoices.
Right. And under a subtraction method VAT, when they come to audit you, all they'll say is, show me your books, you sold 100, and then
Right.
you don't have to produce those invoices. You do not have to prove that the prior, the purchaser paid their tax. And that's a huge difference that's going to have a lot of implications for border tax adjustments,
Yes.
for whether you get refunds, for overall tax administration. So it sounds very geeky and very very detailed, but it's
Right.
the implications go through the whole policy proposal, and so and that we are not going along with the rest of the world on this is I think in the opinion of most tax professionals a major mistake.
Oh, okay. Well, we kind of already talked about, whether it's a consumption tax. So just to clarify though, would you describe the blueprint as a consumption tax?
Well, no, I would.
Yeah.
It has the
It's
features.
going there.
It's almost. It's
Okay.
close.
It has it's like a consumption tax with a big wage
That's the
wage credit.
difference.
So everything
Got
you
it, okay.
so for example, everything you purchase would be subject to the value-added tax.
Sure.
And that would be a consumption tax done. That would
Goods
stop.
and services.
But then we also gave you a fifth. Let's say if that tax rate was 20%, then we also were going to give you 20% tax credit on your wages.
Okay.
So it
It's
is.
kind of an extra layer there.
It's an extra layer. Yes.
Okay. Well, let's talk about the currency exchange rates. There's a huge debate going on right now about whether currency exchange rates would adjust following the enactment of the House blueprint, and that's due to the border adjustment. But the VAT also involves border adjustments, and most other nations, as we spoke about, have a VAT. So are there things we can learn about exchange rates from looking at those other countries' experiences?
What do you think, Bob? 160 countries. Go ahead and tell us.
Well,
Each one individually.
Yeah, it's very hard to look at empirical evidence out there and say that this country introduced a VAT in this particular year and this happened to their currency, because there's other things,
Sure.
you know, the business cycle and swings in monetary policy or fiscal policy. So it's hard to look at other countries and say, yes, the currency did adjust. Because I don't have the letters PhD in economics after my name, I'm a little bit more skeptical than some of my economist friends are. I mean, I think they're correct when they say the currency exchange rates adjust if certain conditions hold. I'm not sure if all the conditions hold, but the person who, if only there was an economist around.
If only we knew one.
Yes. Why are my friends in economic sciences so convinced that currency rates will, almost like by definition, adjust?
Well, again, it's the conventional wisdom in economics that the dollar will appreciate if we impose a value-added tax or a cash, anything with border tax adjustments.
Okay.
And some very, very prominent economists, including Martin Feldstein, Nobel laureate Paul Krugman, Alan Auerbach, former Treasury Secretary Larry Summers, say there's no question about it, this is going to happen. So since I don't have a Nobel Prize and I haven't been Secretary of the Treasury, it's hard for me to argue with them. But that is generally the consensus of the economics profession. I've seen both empirical and theoretical work which questions whether there will be full adjustment of the currency to offset the trade effects of the border tax adjustments. Now, and so that's just the economics profession. So I think there is some, and then there's also the issue of the timing. Some folks, some economists say it will happen immediately. Others say it will happen over many, many years. All of this is maybe, we don't really know for sure. And then as far as the economists on Wall Street and all the analysts and all the opponents of value-added taxation and the destination-based and cash flow tax are concerned, they just absolutely don't believe it. They just think it's impossible. It's going to happen.
Yeah, business people tend not to believe this.
Right, because they think there's so many other factors which affect the markets, and they have a lot of good good arguments.
Absolutely.
I think the takeaway, is that we are uncertain, and so the uncertainty itself has an effect upon the markets. So we're just going to have to wait and see if that's going to happen. But certainly the opponents of this bill are claiming that what's going to happen is the currency will not adjust, and therefore, when you impose a tariff on the imports,
what happens then? What happens if they don't adjust?
They don't adjust the prices. The prices that you pay at Walmart.
Yes.
Unless the Walton family is willing to absorb the losses,
Not
the prices are going to go up at Walmart. So in all imported goods, the prices of imported goods will go up. And since a lot of oil refiners import their oil, the prices of gasoline may as well go up. And then industrial products, because we have global supply chains now. If I make my engine in Mexico and then install it in the United States, there will be a tariff on that import.
Yeah, people keep on obsessing about Target and Walmart, but we as a nation are positively awash in imports. Imported watch, imported car, imported coffee cups from Taiwan.
99
Espresso in the mug is from Italy. I mean, yes, it's everywhere. This is probably imported. So
99% of all clothing is imported.
Yeah,
this was made
Malaysia or someplace. Yeah. So if the currency rates don't adjust, the word inflation comes to mind. Is that what we're talking? Is that an outlandish claim to say that there will be across the entire consumption economy inflationary pressures?
Yes.
And when you get inflationary pressures, what happens? Aren't people a little bit more cautious to go out and spend money?
Sure.
And then that sounds like you're having a weakening effect on aggregate demand. And when you hear about aggregate demand being weak, well, that's sort of like, the seeds for a recession or an economic downturn. And why would you ever bother to do tax reform if you think is going to create inflation and recession and all these bad things. Because the whole point, one of the whole points of doing tax reform is to have growth and to have better economic outcomes. So this issue about whether the exchange rates adjust, to me, it's the difference between the House blueprint being a winner and a loser.
Yeah.
And there's some people out there who are just going to say, why take the risk? Let's say there's a 90% chance exchange rates are going to adjust. Well, then there's a 10% chance they won't, and all these bad outcomes come about because prices will come up. Why take that risk? I mean, even if I'm 90% inclined to agree with the theories of exchange rate adjustment, if I'm a risk-averse person, I don't want to take that chance.
Well, I am in defense of the destination-based cash flow tax. Now, I do believe, and we could spend many hours talking about the difficulties with it, and just to get to my conclusion, I don't believe we're ready as a matter of administration and economics to adopt a cash flow tax anytime soon. But in its defense, it would have tremendous advantages because we get rid of the transfer pricing problem, the profit shifting problem, where U.S. multinationals now very easily shift profits into tax havens, tax havens like Cayman or Ireland, or into the middle of the Atlantic Ocean, as you say, stateless income. The other thing, which I even think is more important, is right now, if you have to build a factory, it's a very simple case. Where if I'm going to build a factory in Indiana, or I'm going to build it in Ireland, if I build it in Indiana, it's going to be a tax rate of 35%. If I build it in Ireland, it's going to be a tax rate of 12.5%.
Yes, less than half.
When you have a destination-based tax, those not only does it level the playing field, but if Ireland keeps its 12.5% tax, you are going to have an incentive to move production into the United States.
So
and after all, Bob, isn't that what it's all about?
Yes,
Jobs?
that is what it is all about.
So,
and I don't like inversions.
So I'm not saying there are major problems with the destination-based capital tax. It's a whole new system, entirely different than anything we've dealt with before. And also, no other country in the world has a destination-based cash flow tax. So we're in uncharted territory.
So 160 countries have a VAT, and nobody has.
The potential economic benefits are astounding. Compared to something like the 1986 Act. But you're right, Bob. We could achieve many of the same goals by going to a VAT instead of to this destination-based cash flow tax. So I agree with you, and I don't.
Bob the cynic is saying you've got 160 plus countries getting some of those advantages through a VAT, and we want to take the world's greatest economy and impose a high school science experiment on top of it, hoping that the rates adjust. Now that's very pejorative, so my apologies to high school students. But there are other issues too.
There are. Let's talk about them, because actually this is a major issue. The World Trade Organization has a major influence here. There's been much discussion about whether the border adjustment in the House blueprint actually violates WTO rules. And if so, that's a reason to reject that proposal. How is it that all these VAT regimes that we see in 160 countries across the world pass muster with the WTO if this border adjustment would not?
Okay, that's another. I'm very glad you asked that question, because it interfaces what we were just talking about. But it's going to take us a second to get there. Okay. First of all, to get to the bottom line, it seems clear from all the experts who deal with WTO and value-added taxes that this tax would not pass muster with the WTO.
Highly unlikely.
Which means what happens when we don't? We violate the WTO.
We know, because it's happened 3 or 4 times.
First of all, it takes about 6 or 7 years for
There's a lag time. You enact tax reform, and a decade later, the European Union is complaining that you violated the WTO.
We have some time to figure it out.
Yes, just by the time we get used, just by the time the transition rules turn off and we actually get used to it. That's right about the time when the U.S. Trade Representative would be flying over to Geneva, Switzerland to argue the case and probably lose. Because we've done some things like this before. If you go back to the DISC and the FISC and the ETI regimes, going all the way back to the 1970s, we've tried to take an export contingent tax incentive and sort of squeeze it into a corporate tax, a direct tax system. And the WTO says, no, you can't do that. So your question, how come all these other countries can get away with it? It's because the WTO agreement basically gives a pass to that because it's an indirect tax.
Well, the WTO is very formalistic, legalistic. That if you, it values form, form much more over substance. Correct, that's right.
Yeah.
And so the VAT under WTO rules is explicitly allowed. It actually says that you can have border adjustments on the VAT. Now, on this destination-based cash flow tax, even though it's getting back to the decomposition. Even though a VAT is WTO compliant.
Yes.
Okay.
And also, you could any country in the world can institute a wage credit.
Yeah, anytime they want.
And so if we decided to separately impose a value-added tax, which is WTO compliant, and a wage credit, which is WTO compliant, there would be no problem.
Correct.
They just have to be separate.
They have to be separate. And in fact, in other countries, this is
They've
what
done that,
in effect, this is what they do. They raise their VATs, which are regressive and hurt working people. And the way they alleviate the burden on working people is they reduce taxes on wages.
Yeah.
So, and that's one of the ideas behind this destination-based cash flow tax, is that they want to make it less regressive than a value-added tax.
Of course, yeah.
But again, because of these formalistic WTO rules, where when you do them separately, you're caught. But if you do them together, which we're insisting on here, it would not pass muster. The other thing I also want to mention is, we're assuming that the WTO matters, or we're going to pay attention to it. I think the president has, in various ways, said,
these are not ordinary times.
That he might just go, we're going to do it anyway, the heck with WTO. And also, other countries may not wait for an official ruling to retaliate. They may just retaliate on their own. They might say, what the heck with WTO rules. So, again, this all boils down to a hell of a lot of uncertainty. Because we don't know if other countries are going to retaliate. We don't know how they're going to retaliate. We don't know. We're pretty sure we know how the WTO is going to rule, but we don't know when that would occur. It might be 5 years. It might be 10 years.
Some folks over in Europe, and we've published stories about this in Tax Notes, that they're already saying they're sort of looking into it, the outline of a complaint. So if this becomes law, the European Union will act quickly. They're already kind of sort of getting started on it. I mean, it might not pass, so. Why drop your complaint before you even have a grievance? But that's an issue. Again, the wild card is President Trump could say, I don't care that it's not WTO compliant. The heck, if he's willing to pull out of NATO and stuff.
And to trade people pulling out of NATO. Pulling out of WTO is the economic equivalent of pulling out of NATO. All hell could break loose. I'm not saying it will, but
it's been a system of and maybe not everyone is happy with the rules, but is a rule-based system for international trade that served Western democracies fairly well for many, many years, for decades, and to just scrap that would really sort of be extraordinary. But
it would make passing this bill easier.
But this is a VAT show, and the point is, if you were to swap a VAT for the border adjustment, then this whole problem goes away. We're only talking about the WTO because it's not a VAT in the House blueprint. It's a border adjustment.
So speaking of VAT, which obviously is WTO compliant, have we tried that before in Congress? Have we had any recent proposals in the past several years? Have we ever tried it before?
Well, there have been proposals for a value-added tax in Congress, but they're very they don't go anywhere. But I can remember them because it's not that many. I can't remember the 160 countries.
Right? He lost his seat.
Well, I forgot about you. Al Ullman in 1980 proposed a value-added tax of 3%, and he got booted out of office promptly after that. During healthcare reform during the Clinton administration's healthcare reform efforts, there were several proposals to have a VAT paid for healthcare reform. Then the financial crisis hit, in 2007, 8,
Yeah.
and the Rivlin Domenici Commission, one of those bipartisan
Yep.
commissions, suggested a value-added tax.
Mhm.
And now in the current Congress,
There's some fans. There's
there are,
yes.
well, at least one,
Yeah.
one or two, on the Senate Finance Committee, which is the tax writing committee.
Sure.
Democrat
Ben
Ben
Cardin.
Cardin from
Yep.
Maryland has proposed a value-added tax.
Mhm.
And to show it's bipartisan, in
Yes.
the House Tax Writing Committee, the Ways and Means Committee, Representative Jim Renacci of Ohio has
Yes.
proposed a value-added tax. In fact, and both of these are credit invoice.
Yes, both of them are
value-added
credit
tax.
invoice VATs.
And
so
so-
no WTO rules.
Now
If
there's-
you do the Cardin plan or Renacci, no WTO problem.
Right.
Safe.
The resistance to this is extremely high from both sides of the aisle, but we can talk about it more, is we're running out of options.
For
here
revenue raisers,
for
yes.
tax reform, and so we may be painting ourselves into a VAT corner as one
Mhm.
possibility.
So what does explain the cultural anxiety that we have in the United States regarding the VAT? It seems like we're really hung up on the label VAT. We're scared to even call something a VAT, especially politically. Is there a valid reason for that?
Culture. I mean,
Well,
yes.
in Australia and in UK, most recently Australia
Yeah.
enacted a value-added tax. They didn't want to call it a value. They called it.
Right, they called it a GST.
They called it GST.
Yeah.
So that's one way
So
of
we could
getting around it.
relabel.
Yeah, actually, they're.
Well, the Cardin plan isn't called a VAT, it's called a
yeah.
PCT, a progressive consumption tax.
Okay.
But it's
So
VAT.
You can play all day with.
Yes, lots of acronyms out there, but why do we not want to call it a VAT? I think it just has to do with American exceptionalism. You know, we don't have the metric system, soccer isn't our dominant sport. You know, we don't want pictures of the Queen of England on our currency, the Boston Tea Party, take your pick. We like to do things our own way. And there's what I've heard from a lot of people is that there's a concern that VAT is such a potentially large revenue raiser that once you implement it, even if you were to implement it at a very low rate, there's the analogy of the camel's nose under the tent, that once you have that VAT there, what's going to prevent the rate from climbing ever higher? And then you wake up one morning and the public sector is 70% of GDP and you're living in socialist hell. And it's a nightmare. Now, I'm not saying that, but that's what you hear because these are sort of like visceral, emotional, knee-jerk reactions. Like, we can't have a VAT because it'll have big government. And in fact, if you look at Europe, there was a period of time when all these Western European countries, our democracies, our trade partners, countries we're allied with, back in the 70s, they were enacting that. And around the same time, you know, if you have a chart, you can see this growth in their size of government. So in retrospect, you go back and you look at that and you think, well, gee, they enacted a VAT, and then a decade later, they've got big government. And is there a causal connection? Are the revenues from VAT paying for all of these, you know, public
Is the VAT a money machine for big government?
Well, it certainly can be. Now, the response is, it's really not causal. It's maybe an enabler, but it's not causing it. Why do you have these European social welfare states? It's because they're democracies and they have elections, and there are people campaigning for office telling the electorate, if you vote for me, I will give you this program, and that's all spending. So you have people promising big government, and you have voters who voted those parties into office, and that's why you have big government in Europe. It's democracy. It's what the people voted for, and it sort of happens to coincide with VAT. But if you didn't have VAT, I'm sure they would have found something else to pay for it. They could have a carbon tax. They could have other types of taxes.
One notable exception that's useful is in Canada, the conservative government put in a value-added tax, and actually since then they've lowered the rate. So it's not an absolute iron law that a VAT has to grow.
Yeah, I think Canada introduced, and Canada is one of those countries that doesn't call it a VAT, they call it a GST. I think they introduced it at 7%, and now they've lowered it to 5% for the federal rate. But for various cultural reasons.
Well, you know, also the Democrats also don't like that, or afraid of consumption taxes.
Well, why is that? Why would a Democrat be against a consumption tax?
Well, because consumption taxes are regressive, and the reason they're regressive is that when you're don't have a lot of money, you spend it all. So basically 100% of low-income people's income is consumption.
They spend all their disposable income. They have no savings.
Bill Gates, let's say he makes $1 billion a year. I don't think he spends $1 billion a year. He probably spends a small fraction of that.
Yeah.
So as your income rises, this percentage of income that is subject to a consumption tax goes down.
Right.
And so there's always,
so it's regressive.
It's very well understood, by it's ingrained in the Democratic
it is.
bloodstream that you're against consumption taxes.
Yet Ben Cardin, the gentleman in the Senate who's proposed the credit invoice VAT, he's a Democrat.
Yes. No, and I say that's a knee-jerk reaction because there are many ways to make a VAT less regressive. And in fact, the destination-based cash flow tax is one very sophisticated way of trying to make it less regressive.
And do people make too much, Marty, about the whole regressivity thing? Because we as a society, we tolerate other forms of regressive taxes. I mean, our payroll taxes regressive, and retail sale, 45 of the 50 states have sales taxes, they're regressive. I mean, lotteries, you want something that's regressive, look at lotteries. Now, I know that's not a tax.
Well, I think one thing that's very important that, for example, the Clinton administration never paid attention to is that not every provision in tax law has to be progressive or not regressive. Is that you want the overall system to be progressive.
Sure.
And so as you were, for example, you were pointing about in Europe.
Yes.
Now they have regressive value-added taxes.
And the rates are high.
But they're getting, not even through the tax system, but through the government expenditures, they're getting health care.
Yeah.
Okay, so that when you have to look at the whole system and say, now is the whole system progressive? And so you can have a regressive tax and not be
Okay, so this question goes to that. In the European Union, they've got a directive that says the standard VAT rate, it can't be higher than 25%, and it can't be lower than 15%. There's a range. And when you look at some countries that we always regard as big social welfare states, countries that, for lack of a better phrase, really love their poor and care about the lower classes, countries like Sweden and Denmark, those very progressively minded countries, they maxed out on the VAT rate. They set their VAT at 25% because it's the very highest that they're allowed to. If they were allowed to go higher, maybe they would. So if they're so sort of liberal and social welfare state oriented and so progressive, they're taking a regressive tax and they're maximizing the rate. And you're saying the explanation is the benefits principle. Is that right?
Yeah, either they're offsetting income tax, so you could have a regressive consumption tax, and then next to that you could have a very progressive income tax, which on net offsets, or you could have government expenditures targeting
the spending
poor.
profile.
But this gets back to what I think is a very important point. I always say, why does as you know, the United States has the highest corporate statutory rate in the world. When you count state taxes, it's over 39%. And I always say, like, what are we, a socialist country? Why do we have, of all countries, why do we have the highest statutory rate? I mean, I think pick your favorite socialist European country. They all have significantly lower tax rates, corporate tax rates than we do, which makes them more competitive. And the reason is, every case I've looked at, is that they use their value-added tax revenues to pay for their lower corporate tax rates. And in the United Kingdom, they're approaching 20% on their corporate tax. Well, guess what? They raised their value-added tax from 17.5% to 20%. In Japan, same thing. They're lowering their corporate tax rate. Guess what? They're raising their value-added tax rate.
You see that all over the world.
Now, economically, I have to mention that the corporate tax is the worst tax for economic growth, while a consumption tax like a value-added tax is the best tax for economic growth. So, very simple. If you're teaching beginning year economics, you say, well, how do you make the economy grow? Well, you'd say, well, let's get that corporate tax down and let's get that value-added tax up, raise the same amount of revenue.
Oh, that is the dominant trend in international taxation.
And now, because we have this VAT phobia, we
Right.
absolutely refuse to consider a VAT, we're tying our hands behind our backs
Sure.
and making ourselves less competitive.
Yeah.
Sure.
And so and we're trying to find other ways to raise revenue to pay for lower rates. We couldn't do
Right.
it in 2014 with Mr. Camp's bill. Doesn't look like we're going to do it in 2017 with this blueprint. And I don't see anything on the horizon that's going to get our rate down, except maybe the border tax adjustments. But now that those have run into so much political opposition
Not
that they're
everyone likes
saying if you get rid of those, we might have to have a 28% rate, which will be very embarrassing to Republicans because that's what Barack Obama wanted.
Yeah, they promised a low rate.
So they really have painted themselves into
Right.
a corner in over-promising. If we can't have a VAT, if we can't have border tax adjustments, if we can't raise taxes on the wealthy,
What do you do?
Where's the money going to come from?
Well, we know what other countries have done because you just have to read Tax Notes International, and you see it right there in the pages in black and white almost every single week. The dominant trend in international taxation is to decrease capital taxes, the corporate tax, and basically at the same time increase a consumption tax. And I can't tell you how many times I've gone to events put on around DC by the various think tanks, and they talk about the big trend in global tax, and it's the fall in corporate tax rate. And they'll have elaborate PowerPoint presentations of all these countries and how their corporate tax rates have fallen. And the takeaway is that that's true, but that's half the story. Because those exact same countries finance those corporate rate reductions by increasing their VAT. So the dominant global trend is not just to cut corporate tax rates, it's to do that and increase the VAT. And because we don't have a VAT, we can't do that.
We are struggling.
So as you said, we don't have a seat at the table as far as that global trend.
And it's very important because we're talking about our international competitiveness. It's not just
There are consequences.
It's not like we're getting less medals at the Olympics. It's
that's important too.
That's important
America
too.
needs all the medals
We're
it
still
can
doing
get.
well there.
We're the best country in the world.
Well, I think we could talk
Except
about
for
this literally all day. There's so much to discuss, but I've learned so much about the VAT, and it seems to be playing a huge part in the global tax community at this point. So we'll see where it goes with the blueprint. We'll see if maybe they propose a VAT or if we go through with this destination-based cash flow tax. It all remains to be seen. So thank you both for helping us today, and
thank you
for joining us, and we'll see you next week.